In this video, we're going to talk briefly about why the market has had unrealistic expectations for valuations, and we're also going to dive into Apple, which is the #1 stock on my watch list for you guys. Welcome back in YouTube. So we are up against it. The S&P 500 is sitting right around 3,800 currently, and this has definitely been a key level for both the bulls and the bears. It is where the battleground is taking place in this market. If you are new to the channel, welcome in. The whole purpose of this channel is to simplify investing and give a process on what you should be paying for individual stocks. It's not always perfect, but it is a process that I personally use. As we can see here, we have Apple at #1. Current price is at 126. I've had a price target of 113 for about 9 or 10 months roughly for Apple. And what I'm going to do today is just kind of update these numbers. As quarterly reports come out, it's always good to update your projections because that does change the target price as growth rates either expand or decline, as margins either expand or decline. It's always going to impact your target price. So always make sure that as quarterly reports are coming out, you're updating your watch list and your price targets. So currently right now, the S&P 500 is sitting at 3,800, and this has definitely been a key level for both the bulls and the bears. It's where most volume comes in. It is where we get the most volatility. It's definitely the thesis for both the bulls having a soft landing and the bears saying that we're going into a deeper recession than expected. And that's kind of the two theses that are on the table right now. You either have the one side that's very bullish and thinks that we're going to have a soft landing and that this is a tremendous buying opportunity. And then you have the other side that believes that we're going to head into some sort of steep recession. And I tend to be in the middle of this. I think we're going to go into a recession. I'm not so sure how steep it's going to be, but I tend to believe that this is an inflated S&P 500. So what you have in front of you right now is just the 10-year treasury, and this is what makes the world go round. The debt market is what makes the world go round. And as we can see here, since 2009, we've had extremely soft financial conditions. We can basically borrow money very cheap, and that has exacerbated this bull run, in my opinion, and has removed valuations from a point of reality, in my opinion. I tend to believe that most valuations are extremely, extremely expensive. I don't necessarily believe it's a .com type of expensive, but with the recent SPAC deals and a lot of these companies that are basically pre-revenue type companies, it is very, very similar to a .com bubble in my personal opinion, and I've stated that for over a year now. But what is happening is now yields are starting to move up here to get inflation under control, and we're at a point in time where we only can compare these type of yields to about 2007, 2008 timeframe. Valuations do contract in these type of time periods, and that is usually the sign of an economic cycle coming to an end. And I know for a lot of people subscribe and loyal to this channel, you already know all of this stuff. But for people that might be tuning in, I definitely wanted to just touch on this. So what do we do going forward? We have to be very good at valuing risk versus reward, because there are areas now where we can get a risk-free return essentially. 10-year treasury could definitely be one, but with an inverted yield curve, we know that the 2-year treasury is actually paying more than a 10-year treasury. You're actually getting paid more to lock your money up for a shorter period of time and take on less risk. And this is definitely a competition for stocks. So stocks are getting a couple headwinds here. #1 is that the cost of capital is going up, so they can no longer borrow at discounted rates and get a return on that free capital. This is slowing down growth as well. So the growth rates in a lot of these companies are going to slow. They're not going to get the return on their investments. They're not going to be borrowing as cheap as they used to, which is going to impact their bottom lines. So there's multiple headwinds we can see just in the yield market here, ladies and gentlemen. And on top of that, there's a new competition for stocks, and that's essentially the 2-year treasury. Now, when we look at what analysts' expectations are, we can see 179 as a price target, and I've heard as high as 250 from Loop Capital. And they justify this price target. Loop Capital justifies this price target as if Apple does go into the automotive business, that is going to substantially grow their business and put them back on the growth side of things, which you can pay a higher multiple for, and essentially is untapped capital that they're going to get into. With 21 buy ratings, you would think that Apple being in the 120s is an absolute steal with tremendous amounts of upside. And I would say, yes, that could be true, but let's just hold on a second here and let's run our analysis and see what we personally get without looking at the professionals. What we have to understand is the professionals have to stay invested regardless of what's going on in the market. So they kind of need to cheerlead some of these stocks. They need people to feel confident in their price projections. And so you want to go in it with an unbiased opinion. And yes, while using these projections is always a good idea, base these projections off of what you're getting. So we can see here we get an average price target of 179. Currently, you can buy as many shares as you want for 126. And if we go off of the 1-year chart, this would look like an absolute deal, as the 52-week high on the stock is nearly $180 a share, and the 52-week low, well, we're basically sitting at the 52-week low at 125. Now, one thing I definitely want to point out with Apple is they cornered the market extremely well during COVID, the electronic boom that took place, the new computers, the new laptops, the new tablets, the new iPhones, definitely helped them traject their revenue, in my personal opinion, okay? I think the stay at home, we thought we were going to adapt this stay at home mentality, and that just doesn't seem to be the case. Now, a lot of people are staying at home, and there is definitely this hybrid workforce out there now, but it wasn't adapted to the point we all thought it was going to be. And people do have to go back to work, and things are getting back to some sort of normalcy. But I would say overall, I think the pandemic exploded their revenues and pulled forward demand for Apple for an extended period of time. How many years is that going to impact them? I would say it's probably going to be a 2 to 3 year window, where I wouldn't be surprised if we see Apple's revenue flatline and not have the growth that everybody once thought, because demand was pulled so much forward in 2000 to 2001. I could be completely wrong here, but this is the thesis that I'm personally building here, ladies and gentlemen. This is what's setting me apart from a lot of the other analysts. So the first thing I like to do is kind of get the fundamentals in place here and build a realistic expectation of what I think Apple is capable of. And when we look at a longer time frame, we really do see that 2021 was a blockbuster year for Apple. I mean, a couple things you just have to pat Apple on the back for, and it's going to be that clean balance sheet, the steady growth, and the margins, right? Margins are phenomenal in this company. They do everything right. And just because a company does everything right, does that mean you need to overpay for them? And the answer to that is no, because our purpose as investors is to find value, uncover that value by investing, and then once that value just is discovered, that's when we decide when is a good time to sell. And having a process helps us. It's not always a guarantee, guys, but it helps us to understand if we are getting value and when we should be uncovering that value and when we should be unlocking that value by selling it. Now, over the last couple of years, we can see that the forward PE ratio has come down substantially on Apple. And this is part of the contraction that we talked about earlier in this video. And this becomes the art of finding value. What kind of multiple does Apple truly deserve? And that's where the subjectiveness of this comes in. Growth rates. Projecting out the growth rates is subjective, because I might be more bullish than most, or I might be more bearish than most. Coming up with a multiple is subjective, because I might be more biased to Apple because it's my favorite product. I think they have a tremendous moat, and I think that it deserves a higher multiple than any other stock in the stock market. For me personally, I always err on the side of caution and undershoot every stock that I'm interested in, because the only thing I'm doing is building safety when that happens. It's a big reason why there's a huge disparity on price targets for companies like Tesla, Palantir, because there's so much bias in these type of companies, because there's so much hype, and because they do have strong growth rates, people tend to overestimate what they're capable of. So when we take a look at forecasts for revenue here, we can see we got about 4 to 5% revenue growth going over the next few years. I think that's about appropriate for Apple. Probably could definitely surprise to the upside here, but I think it's safe to use these type of growth rates for a company like Apple, more mature. When you're talking about $400 billion in revenue, it is really hard to squeeze out 2 to 3% revenue growth, let alone 5 to 6%. I'm going to start plugging in growth rates that make sense for us. And I do think that about 5% makes sense from years 1 through 3. I think 3% makes sense from 3 through 6. And I think 2% makes sense from 6 through 10. Apple consistently has over 30% EBITDA margin, so we're going to go 30, 31, and 32. And so when we look at it from that, I think that if you can accumulate shares anywhere between $80 to $100, I think you're doing something. I think you're buying a tremendous company at a fair value. And that's kind of the golden rule with investing. You want to buy phenomenal companies at fair values, and I definitely think Apple falls in that category. So for me personally, guys, I'm going to be putting an $85 to $95 price target on Apple, which means if it does break below that 103 mark, I really get interested in Apple. I think there's a tremendous amount of upside and a tremendous amount of safety built into these valuations. Does that mean it's going to go to these levels? Could not, guys. That's another 15-20% decline from current levels, which means that I might miss the boat on Apple here. But if I do stay disciplined and I do get to these levels, the conviction I'm going to have to be buying at these prices are going to be much higher than most. If I do get in around $90 a share and it does go up to 240, do I start selling at 240? And that's where it comes down to the quarterly reports. Are they growing? Are they beating expectations? Because if they're beating expectations, then the answer is no, I don't want to sell because there's still value that needs to be unlocked. Are they undershooting expectations? Are they actually letting our growth rates actually slowing? And if the growth rates are slowing and I'm reaching these 20, 30 price targets, then I might want to take some chips off the table because they are not performing to what my valuation says they should be and what I should be paying for that performance. So as you guys saw, I think anything around that 103 gets really interesting. My personal price target is going to be sitting right around 95 a share. And I updated this on January 5th, 2023. Hopefully everybody enjoyed that, and we will see you in the next one. Peace.